And our longer term assessment of gold and silver is very bullish, and it's freshly so. Most people tend to notice the drops that occur in the precious metals and point to it and say, see, I told you it was the top, okay? Uh, I think it's just a lot of emotion, and I think you have to tend to look at longer term factors, especially when you look at long term trends in gold and so forth. They don't last for a year or so and then fail. We just broke through, annual momentum of gold actually turned up in February 2016. We got bullish at a price of $1,140, which is $90 off the bear low. And we added in late 2018 to our bullish view. And then price broke out. And if you look at a gold chart going back several years, you'll see this big basing action where gold labored with all of its highs being about 1350 to upper 1300s. It couldn't get through there. Multiple rallies failed there. And in 2019, it finally punched through. Silver did the same thing in July of last year. Now, these are fresh, massive base breakouts. We're talking bases that go back years, 5 and 6 years of basing action. You don't punch through something like that and then say, oh, it's all over, I'm going back down again. This is a huge base for gold, a huge base for silver, and we think the bull trend is likely to extend for a couple more years at least, and probably extend in a way that is not normal. Meaning, don't look back at the 2009, 10, and 11 bull trend. Don't look at the rally from 1976 low in gold to the 1980 high. I think we're looking for something a little more chaos theory, a little more accelerated, because I think the events in other markets, and I'm speaking macro technicals and the fundamentals, of course, are such that this could be different this time in terms of the violence of the upside in gold and silver. So that's what I'd be looking for. And I know a lot of people have been shaken out of gold since August, but I think it was a false shakeout, meaning it was a correction only. It was not really a bear trend beginning. And I think that the return to the upside is not likely to be slow and plodding. I have a suspicion that we're going to get something out of gold like what we saw last July. We had a buy signal number for silver at $19.48, which when you looked at a price chart last summer, well, you'd already been up there before. What's the big deal? You'd been up to 21 or so a few years prior to that. You'd been up to the upper 19s 6-9 months prior to that. But 1948, when we hit that price last July, it took annual momentum through a massive triple top breakout at a very shallow level, meaning it wasn't overbought when it broke out. And silver went up 50% in 3 weeks. That's the kind of chaos theory I'm talking about. So if gold is going to resume the bull trend, which I think it will, I suspect there'll be a point it will be so sudden that those who abandon ship won't get back on properly or won't get back in at all, in which case they'll be cussing themselves going forward. I think the inflation we're about to see, is particularly the monetary degradation definition of inflation, not just what the cost of bread is, but the actual quantity of money units that are being produced here and elsewhere, is such that it doesn't even compare to what happened in the inflationary period of the late 1970s. I think it's far more accelerated, far more over the cliff, and therefore the response from gold and silver is likely to be far more dramatic than it was even then. And yes, we expect to see that dual highs at $50 area taken out. And we made a projection several months ago based on some long-term metrics that we were using. And to some extent, it was a forecast not as hard and fast as we normally make, but we thought we could see $200 silver in this bull trend, possibly in the next year or two. And at that point, see gold in the, approaching 10,000 from the underside. Of course, silver at 200 would be a far bigger move than gold merely going from, around the 2,000 level up to, another fourfold move up to upper, anyway. So silver is the place to be. That wasn't true from 2011 through 2016, 17, and 18. Silver vastly underperformed gold. It collapsed more, didn't behave well on the upside like gold was. But last July, when it broke out through our annual momentum, so did it spread, measuring it versus gold. And we didn't just measure the spread as a spread chart, we also did momentum study of it, and it said, no, this is for real. Silver is now shifted to outperform status. And we think it will hold that status going forward. So watch gold, but be long silver.
Yeah, well, that's pretty much what I've done. So good news to hear. And I agree with everything you're saying, although just to go a little bit deeper into it, what leads you to believe that this time is different?
Well, look at the stock market, for example. Okay, it's been the chief beneficiary of central bank largesse. Okay, they started big time. Even Bernanke wrote a paper, I think it was in 2003, so before he became chairman of the Fed, basically intellectually defending the position that one of the focus points of the Fed isn't just interest rates, that kind of stuff, but to promote the stock market, to drive it higher. Because if you cause people to save less money, he said, they'll spend, and that's good for everybody. And he said it basically in those words. So he discouraged, he had a policy that when it went into effect, it didn't work during the 2008 drop. I mean, they were trying then to stop the drop, and it didn't work. So people should remember that. The Fed isn't always on the right side of the equation here. And finally, in 2009, when we collapsed to 667 points on the S&P from, I think it was a 1570 high, finally investors said, okay, you've created this river flow of money. We're going to put it to work. And now it makes some sense to put it to work in the stock market. And we were major bullish at that time as well in March of 2009. In fact, the low week we announced the major turn was underway. We didn't know it would extend for a dozen years. So we've seen one of the longest printed bull markets in stock market history, particularly in the US market. Not so true in European markets where they sort of plateaued really since 2015. But in our market, it's just, it's off the page. And we argue that our market is the greatest beneficiary of what we've seen monetary wise. But ultimately, that trend won't continue. Once you create a reality excess, as the central banks have done, investors will finally get suspicious. Again, the Ray Dalios of the world and other large hedge fund managers who realize the connectivity between that monetary policy and the stock market and how it is not necessarily a reality that sustains. And the shift will begin. I think it's already begun to some extent, where we can measure like upturns in the Bloomberg Commodity Index or gold, or gold miners relative to the stock market. We can start to see that the money flow is being diverted by some investors into those categories.